do I trust the diligence materials are written with the viewpoint that aligns with my viewpoint? And if they don't, that doesn't mean ignore those materials, but it does mean as you read them, understand that the view is different. Who is this VC relative to this business? If you've got a VC that dominantly invests in SaaS software, looking at an industrial manufacturing business, I'd be like, why is this VC looking at that? My average investment is half or maybe even a third of what it was 10 to 15 years ago when I first started. If someone says, the market's huge, everything looks perfect, this company is really well set up for this, and they never mention the risks, that's a major concern for us.
Welcome to the Diligent Observer from PitchFact. I'm your host, Andrew, and every week I share insights and strategies to help angel investors make better bets. My guest today is Alden Zecha, Managing Director at SideCar Angels and board member for the Angel Capital Association. With investments in over 80 startups, including 2 unicorns, Alden brings a unique perspective on building effective angel groups and making smart, early-stage investments. Today, we discuss how to evaluate diligence materials provided by other investors, what makes for strong angel communities, and lessons learned from scaling his own portfolio over the last 15 years. I hope you enjoy learning from Alden as much as I did. Alden, thanks for being with me today.
I'm excited to be here, Andrew. Thanks for inviting me.
So Alden, I have a question for you because as I was researching your background, I think you are one of the most involved people I've ever met. Your LinkedIn shows a total of 9 organizations that you are presently a part of. Is that right?
I haven't counted, but that could well be true. There's definitely many organizations I'm currently a part of. I haven't counted if it's exactly 9, but it could well be.
What does your current order of operations look like in terms of the things that you prioritize? What is your main focus right now in terms of your professional time and attention?
It depends on the day in terms of daily scheduling, what's got a deadline that might be closer. For example, I sit on a couple of corporate boards. I sit on some nonprofit boards as well. And for those, it's a matter of when's the next meeting, what's going to be priority for the next meeting, or is there a special project? For SideCar Angels, which I co-manage here in Boston, a big thing for me is routinely checking on what's on the to-do, what's coming up. And I do that probably, I'd say every morning. I'll look at that list. Now, that doesn't mean that it has to be number one priority every day, but I'll at least check in on that and say, what's got to be done right now?
I love it. So Alden, I want to come back to SideCar Angels, which you just mentioned. How did you get involved in angel investing in the first place?
So I'm a serial entrepreneur as well. I've started several companies myself. Some have not done well. I'll be right up front with that and say that. Others have done okay. And so that got me looking at things from the entrepreneurial side. And I've also, in parallel, always been interested in investing broadly across initially the public markets. And then as I got into entrepreneurship, I realized the potential benefits of investing in the private markets, the early stage private markets being angel investing. And so began to get involved in angel investing about 15 years ago, roughly, mainly through people I met and got to know who were entrepreneurs looking for funding. And so began to do that as an individual initially. Then I joined SideCar Angels as a member back in 2012 when it was forming. And then I became co-managing director of it in 2017. So I'd been a member for 5 years and then moved up into that management team slot.
And you've got a pretty diverse angel portfolio over that 15 years. Is that right? How many total investments have you made? And if you had to pick a concentration for the industry or sector, how would you break down your portfolio?
I think if we look at it as number of companies, I think I've invested in probably 80 or maybe 85 companies now total over that period of time. If you look at number of rounds, it's definitely well over 100 because some of those companies have had multiple rounds. Obviously, there's follow-up rounds. My portfolio is very diverse, as you said. I am a believer in portfolio diversity to an extent. So I have geographic diversity, industry diversity, not so much stage of company by definition. I'd say if I broke down my portfolio, probably the 2 largest segments would be software, mostly SaaS software, and mostly B2B SaaS software, to be clear, and medical device or medical related, but not new drug. So diagnostics, testing tools, equipment, things of that sort. Those are probably the two biggest segments. But then I definitely have a part of my portfolio that's in the social impact space as well. I am a big believer that social impact businesses can be very profitable and can have positive returns. So that's a segment of my portfolio. It's not as large as the other two, but it's definitely an intentional segment. And then I'd say there's a number of, I call them semi-random one-offs that are businesses that I thought were interesting, appealing, had the potential for a positive return, but don't necessarily fit into a well-defined bucket, or sometimes even into a thesis of mine, other than it's helping to diversify my portfolio.
Alden, it's fascinating because most angels that I talk to don't have the breadth of a portfolio that you have. There's so much conversation about portfolio theory and how important it is to build this diverse book of investments, but very rarely do I see someone with 80 companies in that portfolio. I wonder if there are any takeaways or any things that you have found have evolved in your approach to writing these angel checks that you've noticed in recent years.
My approach to angel investing has changed and evolved over time. I think it does for everyone, by the way, hopefully in a positive direction as they gain more experience and they learn what is right for them. One is, as time has gone on, I have, in general, placed smaller bets in terms of dollar value across more companies. And that's intentional because of trying to have more of that portfolio view. So rather than putting as much money as I might have 10 plus years ago into a single company, I would say my average investment is probably half or maybe even a third of what it was 10 to 15 years ago when I first started. There's certain aspects, there's certain ways to facilitate that. I'll mention those in a moment. But I think that's one. I think another is to really be more intentional in saying, why am I investing in this company? Or why am I considering an investment in this company? Is it because I think that the entrepreneur is a great leader, is going to build a great business? Is it because I think the business is solid? Is it because there's some emotional pull? They're solving a problem that I personally face and feel attached to, and so on and so forth. And trying to separate some of those personal, emotional aspects from what I would call the more objective business or investment focused criteria. I would say early on, a number of investments I made, and not surprisingly, many of those did not do well, were more emotionally driven and were more driven out of personal interest. As I've gone on in time, realizing that investment is something that should be an investment. Now, there's a difference if you're thinking philanthropically. If your goal is, I really want to help this person who's an entrepreneur or this cause, that's fine. If you approach it as, and I'm intentionally doing this philanthropically, that's fine. And I've definitely continued to do a couple of those, not often. It's much more intentional rather than I'm fooling myself into believing it's an investment versus it's more of a donation or a charity play. One thing that's allowed me, and I think potentially your listeners or your viewers, to think about how to make a broader portfolio investment with the same amount of money, so less money into each deal. And this is one of the things that SideCar Angels, I think we're really good about, is we act as an aggregator of money from our membership and then are investing that. So our minimum ticket size per member is actually very low. In some cases, it can be low as $1,000 per member for a deal. But because we're aggregating across many people, the entrepreneur, the company sees it as still a reasonable size ticket. So our average ticket is around $100,000 as a group, but an individual may be investing very little. It helps to build a portfolio by leveraging kind of a group strategy or group administration. There are many groups that do this, SideCar being one of them, and we were able to do that. Other people just look at it and get that diversification through investing in a fund. That's another way to do it. The big difference between an angel group and a fund per se, though, is how active the investor is in influencing the decision of what to invest in and also tracking and maintaining information. So SideCar is set up where our members actually vote as a group on what we're going to invest in. And it's a simple majority of the votes carries the day. If there's a majority yes, we invest. If there's a majority no, we don't invest. And so that allows members to be very involved in the decision-making But because of the aggregation aspect, they don't have to be writing 10, 20, 25,000, 50,000, $100,000 checks individually. So that allows greater diversification, again, with the same amount of capital.
And say more about how you got involved in SideCar in the first place. What was so compelling to you about the organization? And then say more about your journey into a leadership role over the last several years.
I got involved in SideCar initially because I was, at the time, running my own startup or co-running my own startup with my co-founder. Full-time job, obviously very busy. You're an entrepreneur. You don't have a lot of time. What I liked about SideCar was the structural model and how it differed from other groups. A lot of groups either require or strongly encourage their members to get involved in deep due diligence. And understandably, one doesn't want to just blindly invest in a deal. You want diligence. SideCar's model is very different in that we only invest as syndicate partners. We do not lead deals. And we work with the deal leads to access their diligence materials, to access their research. And that helps us make intelligent decisions without requiring our individual members to necessarily put in a ton of time. And as an entrepreneur, that was wonderful for me because I could participate in the asset class, I could invest, but I didn't have to commit 50, 100, 200 hours a year to doing the diligence work that would be required. And yet could still feel comfortable that the deals I was investing in had gone through reasonable diligence. So that's why I first got involved with SideCar, and the fact that it was a low ticket size initially. Because when you're an entrepreneur, you don't necessarily have access to a lot of what I call disposable income or disposable capital, because honestly, a lot of your capital is going back into the business you're running, right? So there's that aspect. In addition to not having capital because you're not necessarily getting paid a lot, you don't have a lot of capital because you're plowing a fair amount, depending on who you are, of your capital back into your own business. And so that aspect also was appealing to me, that I would get or have the ability to access deals that might have a $50,000, $100,000 minimum participation threshold, which as an individual at that time, I wasn't able to meet, but I could access those deals by participating through an aggregating group. So that was also appealing. That's why I got involved. My journey into leadership of the group obviously didn't happen overnight, happened over time. In 2015, I transitioned out of being a day-to-day entrepreneur. I transitioned out of managing my own business, stepped back from that. My co-founder continues to run that business and has done a very good job with that. I'm very supportive of him, continue to be. But then transitioned into a role that allowed me a little more time, a little more flexibility to pursue other things, and also allowed me to really think about what did I value in my time and my efforts, and where did I want to expand those. That led me on a path toward management of SideCar's Angel Group. SideCar had also, during the period of 2015, 2016, 2017, SideCar's previous manager had gone through some changes. One of the managers had retired and had relocated for personal reasons across the country. And so that opened up a gap in the management team, and the timing worked out well that I was able to then move into that gap. If you're interested in getting involved in management of a group, don't be shy about talking openly with the managers if you're already in a group, or if you're not in a group, with managers of other groups. I think there's always this aspect of angels feel, or individuals feel like if they approached a group manager and said, gee, I'm interested in potentially either replacing you. Obviously, there's a sensitivity there, but in joining working with you as a manager or becoming a group manager, I think you'd be surprised that most group managers, other than those who just started literally like in the last year or two, I think most group managers would welcome that conversation. The vast majority of group managers feel overworked, and I think they are, and really would love to have additional resources, additional partners to spread that load. But also because having multiple group managers up to a point, obviously you can't have 50 group managers, helps groups get stronger because you have that benefit of having different viewpoints, of having different strengths. Everybody's got different strengths they're bringing to the table, and you apply different people in different ways. It also, by definition, brings often larger networks of people who you can use as either supplier or vendors, providers, but also as potential members to join. Very few successful angel groups, in my opinion, are led by a single individual. Most of the more successful groups have 2 to 4, maybe 5, but that's kind of pushing it, people running them. Much like we would look at the companies we invest in. Rarely are you going to invest in a company that has a single leader who has no one else with them. Usually they're going to have a team around them.
Break down that taxonomy for me. You're looking at the average angel group. What's the allocation of the ideal? Let's say there's 4 people. How would you allocate responsibilities in a way that you've seen these communities be effective?
Have one person who's responsible for what I would call all the back office and the admin, all the paperwork, all the where's the money moving, who's moving money, and potentially that person would also be the one handling logistics of meetings, scheduling the meeting, getting emails out to members, so on and so forth. I think another person should be responsible for deal flow. Where are our deals coming from? Looking at those deals. Now, let's be clear, that doesn't mean that person is a investment committee or a screening committee of one person, but they're responsible to at least get the top of the funnel filled with potential deals. How do we get those deals in? I think another person I would allocate to member relations. So getting new members, supporting the members, making sure the members are happy, listening to any improvements that they might suggest, concerns they might have, things of that sort. And then I think the last person, if you do have a team of 4, the last person, depending, could either help, again, in part with the administration, because administration is a lot more than people think in these groups. But I'd also allocate to them to working with what I would call the broader community. So wherever the group is located, or if it's a virtual group, then online, looking at, for example, relationships with other angel groups, relationships with VCs, potentially relationships with state or local government for economic development reasons, tying into accelerators maybe, or at least getting relationships with accelerators and things of that sort. So that broader community relation, which is different than deal flow and different than member relations, in my opinion. So that's how I would break out if you had a team of 4. Hopefully, those people's skills and strengths play well to that. Obviously, if you have 4 people who are great at the deal flow and none of them are great at administration, well, you might be able to outsource administration. It's a lot harder to outsource deal flow. So you have to find people who are good fits for the needs as well.
Alden, I'm curious, looking at SideCar specifically, could you talk to the pros and cons to this approach of we exclusively follow when there's lead investor already secured with existing diligence material?
In my opinion, there are 3 main stakeholders. And so I'll speak to the pros and cons for each of the stakeholders as well, because they're different. They're the entrepreneurs. There are the other investors, the deal lead, let's say, and potentially other syndicate partners. And then there are our group and our members. So there are 3. And they all have to win, in my opinion, for it to be successful. So first, let's speak to the entrepreneur. The pro for the entrepreneur in our model is it's faster decision-making for them to get money or not get money. But at least if it's not going to get money, they're deciding fast. Low investment of time and effort on their part. So we've actually done some surveying of and tracking. And what we have found is that on average, it is 4 to 5 effort hours for a company that we work with between introduction and a yes/no answer from us. So a total of 4 to 5 hours on their part, not a lot of back and forth, not a lot of negotiation. That includes logistics and scheduling time too, just to be clear, and includes our pitching time. And because we're using, we just match legal documents from the deal lead as well. So we literally say, take their deal documents, obviously change the name and address, those details, and amount potentially. But other than that, we just match their documents. So the legal fees for an entrepreneur, very low. And also because it's a low lift on effort, but it's also a low lift in terms of speed, or it's high speed. Typically, we spend in calendar time, now not effort time, calendar duration is 4 to 6 weeks between introduction and when we make a decision on a yes/no to write a check. So an entrepreneur can come to us moderately late in their round, know they don't have to spend a lot of time and effort with us, and they're going to get a check. I don't really think there's a lot of downside, honestly, for the entrepreneur. So I don't think there's a lot of cons. For the other groups, the other group leaders, the benefit to them is we also, in addition to investing only as a syndicate partner, we never take board seats. We don't take board seats. We're not interested in them. We don't want them. So we're never going to challenge that deal lead's right to be the major investor to take that board seat. So that's fine. Again, we're not going to try and renegotiate any terms. We basically look at a deal and say either, yes, we like that deal, or no, we don't, on the terms that are there. And so that's largely it. So they know we're not going to upset the apple cart in that respect. We're bringing obviously additional money to the table, potentially additional resources, network contacts, and we're fast and easy. So again, because we're not doing deep due diligence starting from scratch, we don't have that calendar duration. So other investors, again, could be VCs, could be other angel groups, could be other parties. When they see that they've got to fill around, they can come and say, hey, look, you guys move fast. You bring a check that's a reasonable size. As I said, our average ticket's 100K, right? So it's not 10K or some small amount. That's just not worth everyone's time. We only show up as one line item. Our entire group invests through an entity as a single line item on the cap table, which means going forward, the company and those other investors don't have to worry about contacting 30, 40, 50 individuals to gather votes, gather signatures to one party. So I think that's the benefit to the other investors. I don't think there's a lot of downside to the other investors, because if they don't like us, in essence, they'll just block us out from a deal. If they don't want to deal with us or work with us, or they want the whole deal for themselves, they'll block us out from a deal and they won't offer it to us. Okay, so be it. And again, because we never lead deals, there's absolutely no competition between us and these other groups or us and these VCs. Let's come to the last constituency, which is our members, the individual investors who are our members. The benefit to them is they're getting to see deals that they might not otherwise because of check size. As I said, depending on the deal, they can write a check for as little as $1,000, but they're getting into a deal that may have a $100,000 minimum ticket size. They would never see that deal otherwise. In addition to that, because we're part of a group versus making all individual decisions, we have a lot of discussion around every investment. So there's the benefit of hearing others' perspectives, hearing what others are saying, yet at the same time, the benefit of not having to do 10 hours of individual due diligence. So that's another aspect. Those are all positive. What are the cons of being a member of our group? One of the cons is you're going to get blocked out of some deals if they're really hot deals and the deal lead wants the whole deal. We're never seeing that deal, because we're only a syndicate partner. And we have to accept that there are some deals that we get blocked out of. And we see them every now and then. We'll see them like headlines or newspaper articles or press releases. And we know we don't blame our deal flow partners for that. We don't blame the VCs, the other angel groups feeding us flow. We understand that's their model, right? And that's fine. The con is we might lose out on some really hot deals. I think the pros, though, in my opinion, for obviously me and our membership, outweigh the cons. But it's not for everybody. There are people who really say, hey, those pros don't matter to me, or those cons are too big, and I really feel like I'm losing out. So that's fine. There are lots of angel groups of different structures for that reason.
Since their diligence is so important for your community's decision-making process, how do you assess the quality of an investment memo or a diligence report that an investment partner is sharing with you?
So when we look at building a new relationship with a new potential partner, and when I say partner, I mean investment partner, so a deal lead or a future deal lead, we look at a few things. First of all, a little bit is what's their track record? What's their thesis? Are they investing only in a particular geography, industry, segment? Does that seem appropriate to us and interesting to us? Obviously, that's a key question. But when it comes to the materials, the diligence materials, as you just said, Andrew, that's a key factor for us. So we're going to look at first of all, do they have written materials? Most groups do, but there are a few that don't. There are some that do everything orally, and that doesn't work for us. So we just say, thank you very much, not fit. We're going to move on. For those that have written materials, there's a couple of key things we're looking for. How thorough are they? And that's both in terms of breadth, as in topics covered, and depth, in what level of detail. So there's thoroughness in two ways, and that's really important to it. And then, how honest are they in divergent opinions? So what I mean by that is we really like seeing documentation that says, hey, here are the pros and cons of this deal, or here are the opportunities and the risks. We don't just want everything to be perfectly rosy, because we recognize that's not reality. So if someone says, the market's huge, everything looks perfect, this company is really well set up for this, and they never mention the risks. Now, it doesn't mean they're lying, let's be clear, but they never mention the risk or the potential pitfalls. That's a major concern for us, because it says to us either A, have they not considered those things? We don't know. Or B, have they considered those things and they've just ruled them out? And if so, why? I think that's another aspect, so that both the breadth of coverage in the documentation, what is covered, it can't just be market size. It can't just be, does the technology work? Is the team decent? We're also looking at things such as, who are the competitors, right? What's the traction to date beyond just they've sold X? What do those customers think about X? How many of those customers are repeat customers potentially, or have renewed subscriptions if it's a subscription product, right? So that's a key element that we're going to look for. If it's a team element, it's not just the team is good, they're smart people, they understand their technology, their solution, which we would hope, but what's their past as well? Have they founded other companies? If so, what did those companies look like? What happened at those? Or have they worked at another startup? Again, that's not a requirement, but if they have, what did they do there? Did they succeed? Did they not succeed? What's the opinion? So those are additional details we'd love to see in reports. We also look at who's the deal lead relative to where's the company. So we look at a geographic lens as well. For example, a company that's a tech company coming out of Silicon Valley, where the deal lead is out of Florida, to me immediately raises some questions and concerns. The question of concern is, if the whole company is based in Silicon Valley, and yet the company had to go to Florida to get the money, that it's like, why couldn't you get the money from the VCs or the angels down the street? I mean, it's not like there's a shortage in Silicon Valley, right? So that says to me, did those investors reject that company? In which case, obviously, that's a red flag. Or is the company not well networked with their local community? Again, a concern potentially. And there are legit reasons to do that, right? It could be, hey, we've got 4 engineers in Silicon Valley, but the CEO and COO and all the founding team are based in Miami. Then I'd say, yeah, it makes sense. Okay, go after Florida money because you're actually in Florida as a team. Got it. But otherwise, it's a question mark. So that's another filter. And we would look for that in the diligence materials is, where's the company based and where's this lead based, right? And that's pretty easy to extract pretty quickly from the materials.
So it sounds like you have a pretty thoughtful diligence process on the diligence.
I've never thought about it in that way, but yes, I think we do.
So imagine you're an angel investor, not a part of SideCar Angels, so not benefiting from this well-structured process. I get handed a diligence report from a small VC down the road that I have heard about but don't know super well. What are the 1 to 3 questions that you would really encourage that individual to ask themselves and to ask of this material that they're looking at while they're considering this deal?
So the first question I'd probably ask is, who is the VC in the example you gave? It's a VC. Who is this VC relative to this business? For example, if you've got a VC that dominantly invests in SaaS software, and now they're looking at an industrial manufacturing business, to me, I'd be like, there's something wrong here, right? Why is this VC looking at that? If it's a VC that invests dominantly in underrepresented entrepreneurs, people of color, and now they're investing in a company that has, at least apparently, no people of color in their management team, it's like, wait a minute, why are they investing outside of their? So who's the VC? What's their normal approach? What's their normal thesis to investing? And does this company fit that or not? It's a really easy screen, super quick to do. The next question is, okay, let's assume this company is in the, call it sweet spot of that VC. How has that VC done in the past? What's their track record? Now, that doesn't mean new VC should be inherently penalized, but there is a question around that. Why should I believe that this VC is qualified to decide that this is a good investment or not? So that's a second aspect. Another question I'd layer on is, what's the motivation of the VC? And I know that sounds weird, but for example, one of the things we look at is, if the lead investor is a government economic development agency whose primary role might be economic stimulus in their city or state, maybe it's job creation, right? They're not necessarily looking at return on investment. They're not necessarily looking at what's an exit in the future, because they're looking at, how do I get jobs created? How do I keep money moving around my economy? Is that in line with my belief as to why I'm investing? You have to look for alignment there as well. It does not mean it is a bad deal for someone, but just understand, what's the motivation of that deal? How are they looking at it? What's their lens? What are they trying to achieve? Is it purely profit maximization or return on investment? Again, that may or may not actually be what you care about as an investor. So you have to ask that question. Those are a couple questions I'd immediately ask, none of which you'll notice have anything really to do with the company. They're all about the VC. They're all about the investor, admittedly with the lens of how are they looking at the company, But none of that is the go talk to the company, what's the business model.
Right, because that all then follows, assuming there's alignment there, then the content and the actual mechanics of looking at the deal and the business model and the strategy are assessed in the right lens, so to speak.
Basically, it comes down to, do I trust the diligence materials are written with the viewpoint that aligns with my viewpoint? And if they don't, that doesn't mean ignore those materials, but it does mean as you read them, understand that the view is different. The author has a different goal in mind. You need to think about, what does that mean for you?
Okay, Alden, so I want to ask, because I saw in your bio that you have a couple of unicorns in your portfolio. Is that right?
That's right. Yep, we do.
Can you tell us about those? Would love to hear the story on both of those investments in as much or as little detail.
Two of them that are in my portfolio, and I can speak very openly about, they're in my portfolio. That's not a secret. One is Easy Cater, and the other one is Wasabi. Easy Cater is a company that provides a marketplace for people who need food, catering, for a meeting or event. And it's basically an online marketplace to go find food providers, caterers. Now, when we say catering, I mean broadly. I don't mean it's necessarily white tablecloth and custom meal. It could be, but it's more often, I need 40 sandwiches because I'm getting a team meeting together. That's catering. It's a different kind of catering, but it's catering. That's much of what Easy Cater provides, that type of thing. And then the other company is Wasabi, which does cloud storage. That's their whole business. Cloud storage primarily for what's B2B, and primarily for large video files is their primary target. Not exclusively, but that's their biggest target. And they have data centers now around the world. They didn't when we invested in them, but they do now. So two very different companies in terms of industry. Obviously, yes, they're both tech plays to some extent. They both happen to be based in the greater Boston area. So there's a little bit of ecosystem familiarity for me with them. Easy Cater was actually the first investment of SideCar. I joined SideCar at its founding, and it was our first investment. So the model is really interesting, and it's done obviously very well.
I'm sure that doesn't hurt your new member acquisition approach.
Not at all. And we've done well with that. We've had several follow-on rounds as well. And so some of our newer members have invested in the follow-on rounds. But that was business. And to me, it was interesting because it was solving a need, a pain point that I could easily understand. You're trying to set up a meeting, you got to get food. And other than the sandwich or pizza shop down the street that you know delivers, who are you going to use? How are you going to find them? How do you filter on them based on food type? And especially nowadays, allergies, can they give you gluten-free? Can they give you diabetic appropriate foods? And so they started to build those things in. So that was really interesting to me. So it's an easy to understand problem, and one where I thought, oh, that makes sense. And it's a model where there's an obvious network benefit. As they get more customers, they obviously get more suppliers, more caterers on their site. As they have more caterers, you're more likely to get more customers. That was, I don't know what that, the scalability made sense to me. And it was at the time when they started an untapped market. So big market, untapped, not a market that I thought would ultimately go to self-solution, i.e., even if you're an experienced administrator who sets up a lot of meetings, maybe you've got your 10 favorite catering companies. But if you could just go to one website, do a few clicks and get the food, and by the way, at the same price, and that's the key element of it, why wouldn't you? Because it's just a lot easier for you. It's got a profile stored, it's got your address stored, blah, 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 blah. So that was exciting. I think Wasabi was very different. I should be clear. Easy Cater came to us because one of the founding members of SideCar knew the CEO, had invested actually in their initial friends and family round. And so brought it to the group and said, hey, here's a company. I invested in the friends and family round. It looks like they're starting to, have some traction. Let's take a look at them. And so that made its way through the process. There was a deal lead, which obviously was a requirement for our group, but that was it. Wasabi was totally different. Wasabi was a situation where the founding team of Wasabi really likes to work with angels. And even though we invested initially actually in their B round, so their Series B, they were much higher valuation already. I don't remember the exact valuation, but I want to say it was north of $50 million valuation by the time we got in, which obviously is unusual.
Yeah, later than most angel groups are even part of the conversation.
But the founder really likes working with angels, likes to support angels in the ecosystem, in the community. And so actively was soliciting angel groups to participate in that round. And the deal lead that they had secured, who was obviously a larger VC because they were putting in $10+ million into that round. And I'm doing that from memory. I could be wrong with those exact numbers, was open to that idea. And so they're basically, through the various connections and networks, made it clear that they would welcome additional investment from angel groups, even quote unquote, as low as our ticket size, which is 100K. In a round that was a $10+ million round, you can understand why most companies would be like, I don't want that 100K. It's not worth my time. It's not worth my effort. It's too much of a headache. But their belief was by bringing in more angels, they would ultimately be able to access capital less expensively, more easily, because they'd have hundreds of potential people to tap for future follow-on rounds, although the valuations obviously ratchet up. And they would have an incredible base of supporters. In essence, soft marketers for them. Company obviously went on to do very well. Now, in that case, the founding team had founded previously another unicorn. So from us, as we're doing our diligence, that's obviously a tremendous benefit and upside when you say, hey, this team, not just the founder, the team had founded a previous unicorn and was moving as a team with this new business. So that was one of the things that really attracted us, as well as the fact that we were co-investing along with many other groups and established VCs that we thought were very reputable, knowledgeable, and trustworthy.
We'll definitely keep our eyes on Wasabi and Easy Cater in the years to come. Alden, 2 more questions for you. One is, what are some of the trends that you're excited about right now that you're following closely?
I think from an investor perspective, a couple of trends that are exciting to me. I think most people would say, oh, AI. That's interesting to me, but I think a lot of the AI investments may be currently overvalued, to be honest with you. And so you have to be very cautious there. But that said, I do think AI from the perspective of being more efficient at both running an angel investment group, or if you're an individual angel, being smarter about how you do your analysis. So AI's ability to tap into large data sets and be able to summarize is incredibly helpful. That said, you have to be really careful that the outputs are real and not hallucinations, because AI can sometimes generate false output. And so you have to be thoughtful about that. But I think as a tool that excites me and that's interesting to me, again, not necessarily as the investing into AI companies, although that does interest me, but I think how do you leverage AI to be more efficient as an investor is one trend that I see. I think another trend that I see that is interesting, I think there's a tremendous opportunity, but there's also tremendous risk. So at the same time, is what's being called the generational transference of wealth. You're seeing a lot of baby boomers, who by definition are older, beginning to transfer their wealth, sometimes voluntarily, sometimes involuntarily because they're passing away, to the next generation or even to 2 generations down, i.e. not just their children, but potentially their grandchildren. I think that's tremendous both opportunity, but also tremendous risk. A lot of those, let's call them younger people, although I am technically in that category, a lot of those people may not have thought about angel investment yet. And now they may inherit or be gifted a significant amount of money, and they may say, oh, this is really attractive to me. And the opportunity is there's a lot more capital that may come into play in early stage. The risk is a lot of those individual investors may not be well informed about the risks of angel investing, or may not be well informed about how to choose angel investments wisely. And so there's that balance of just because there's more capital available does not mean that it's going to be deployed well. That could be a risk both for, of course, the investors who may just end up losing a lot of money, but it could also be a risk for entrepreneurs because those investors may have unrealistic expectations and returns. They may have inappropriate expectations on valuation or deal terms and things of that sort. So I think there's this change coming. This trend is definitely happening, but it's both an opportunity and at the same time a risk for everyone. So I would say watch this space and see what happens. One of the things I do, so I'm a member of the Angel Capital Association's board. I sit on the board and I'm heavily involved with their educational opportunities they provide. And those educational opportunities, they have courses, for example, to teach new angels how to think about angel investing and what to do with angel investing and how to approach it. So those are all things to keep in mind.
And Alden, how can our audience stay connected with you and with your work?
So a couple of things. I'm not at all a social media user very much. I'm not prolific on LinkedIn or anywhere else, but I do exist there. I just don't post a lot. It's not my thing. So I think looking at SideCar and my work through SideCar is easy enough. Just track the SideCar website. We post our portfolio. We're pretty open about deals that have done well, i.e. become unicorns or have exited. We're also pretty upfront about deals that didn't do well, the companies that shut down and were shuttered. We think it's important to be upfront and honest about that. Not every deal comes out rosy, let's be honest. We'd like to think so, obviously, going in, or else we wouldn't invest. But at the end of the day, not the case. But that's how people can watch and follow. And I'd love to, if it makes sense, Andrew, maybe in a couple of years, have a follow-up interview with you or a follow-up session with you and see what happened and what were the results.
Love it. Well, I will definitely take you up on that. Alden, this has been a pleasure. Thank you so much for making the time to join me today.
Thanks so much for having me. I've really enjoyed it. And anytime, I'm happy to help grow the angel community around the world and help educate people more on angel investing and what it can do for them.